Good morning, everybody. It is Friday, December 3rd, and the stock market is getting beat up a little bit today on a really weird employment number. Nobody really understands it. I think what we're seeing is that the folks who are starting to look for jobs are coming back into the market, and the jobs that are open still aren't getting filled very quickly. So what does that mean? I think it means that there's a lot of people who would like to work and they're being real picky with the jobs that they're willing to take, but also the employers are still of the mindset that everybody coming to them is going to expect a average or lower wage and doesn't need much training. And I don't think that that's true. I think what is going on is employers on the very slow road to realizing that they're going to have to pay more and train more, and they hate that. Now, on the labor side, it is clear that we have 6, 7, 8 million people who are underskilled that would like jobs. I don't know how that can be bridged quickly. I've talked about this for years, that there was a skills deficit in the workforce, but there's also an underlying motivational issue. Why are these people underskilled? They're not all disadvantaged. I know plenty of people pretty smart people, but they're just not motivated to learn how to do something. I don't know what changes that. I don't know where in a person's psychology they decide, I want to make more money. I'm going to go learn how to do a few things. In a world of YouTube videos and several different places where you can buy online classes from PhDs for like $29.99, I don't know what it takes. I like the idea of 3K and 4K just to ingrain education. I even like the idea of half price college. I don't think I'm in favor of free because I think you need skin in the game as an adult, but I'm not sure how much more the government can do. So I don't know how quickly this labor problem clears up. Used to be back in the day to me is the late 70s and 80s. Back in the day, there were apprentice programs, and the unions administered those, and a lot of people got trained. Well, since the early 80s, since Ronnie Reagan, they've decided that unions are bad, and they've destroyed unions, cut them down by, 70, 80%. Well, with those unions went the training programs. So if you're going to get rid of all the training programs, you have to replace them somehow. It's not going to be through a junior college or super cheap community college program that's national. Then either the unions have to get them back, or, which means the unions expand, or the employers have got to start training people. I'm not going to say what's right or wrong. I have some ideas. I think it's probably a mix of all the above. But the point that I make is that I don't think it gets fixed quickly. So I think the labor issues for 6, 7, 8 million people in the country are going to persist. I think those businesses that would like to have employees out of that group are going to continue to have trouble. And I think that a lot of the winners from that are going to be the companies, small to big, that can solve that problem, at least internally. So I think that's one of the things I'm looking for is companies that actually can find the type of labor that they need. Because companies that can't hire good employees are in big trouble. And I will say, a lot of this falls on the HR departments. I have been amazed in my years of selling benefit programs back in the more recent day, say the early 2000s in general, that I have not found many HR departments that are very good at their jobs. But I think that there's problems with what their missions are, what their experience is, how their egos function. But maybe I'm wrong. I'd say probably around 100 companies and organizations I've worked with on benefits. In any case, Omicron looks ominous. How bad is it likely to be? So that's the headline over here at The Economist today. And nobody knows. However, a year and a half ago when we were talking about this a lot, and after 3 or 4 months, people told me they were tired of hearing about COVID, so I stopped. I'll point this out. Here's one of the things that we talked about, is that when a virus spreads very easily, it typically isn't super likely to kill you. There is a relationship between ease of spread and how much it kills that's basically inverse. If it spreads easily, not likely to kill. If it spreads really with a lot more difficulty, then it is more likely to kill. So we should hope that Omicron is all over the place, because then it's probably not likely to kill you. However, remember the discussions that I brought up about disease X? Disease X is the one that they've been worried about for 16, 17 years now, since those first outbreaks of SARS back in whatever year that was, 16, 17 years ago. They've been tracking Disease X. What is Disease X? Disease X is one that spreads easily and kills a lot. A plague. So while we have a pandemic right now, it's not a plague. Death rates are right around 1%, higher for the unvaccinated, lower for the vaccinated. It's pretty significant. You're literally like 1,000 times more likely to die. Is that the number? 900 and some times more likely to die if you're not vaccinated. Okay, worry about the nanobots if that's what you care about. I just got my booster shot on Sunday, and yep, I had a fever for a day, and I was tired for a couple of days. Feel pretty perky today. I haven't even had coffee. Going to New Orleans next week, see if it works. I figure they'll have all the new diseases down there. I don't think that we're going to be too worried about Omicron. I think that it is just something that gets into the narrative. I think it's something that if it does turn real bad, we'll know about it quick. But what we really ought to be worried about is this guy. Because this guy doesn't just have a bazooka. He has a nuclear arsenal. And we just saw it at work. That monetary mushroom cloud that I described a couple of weeks ago has the markets peeking out everywhere. And now they're getting real jittery. Shooter, over on Fundamental Trends, has been talking about, and by the way, if he's willing to accept, Shooter will be invited to give a very nice chart presentation on Monday with the stocks of the week. Shooter's been pointing out that a lot of charts are broken, which is what I've been saying. I don't draw as many nice pictures for you as Shooter does, mainly because I think that little orange box works. I take all my indicators, I take my quant factors, and I take a look particularly at money flows, and it gives me a target price to land in. And we're going to come back to this, but I would just like to point out that my target price on Docusign, right, where I'm willing to start looking at it as a bottom fishing price, $124. Did anybody notice the chart of Docusign today? Remember, I've been saying that Docusign was going to get beat up quite a long time. Way down here is when I said, hey, you know, pretty much get back down here. No. Look at that. Fell off a cliff this week. I mean, who would have thunk it? It's at 137. It was over 200 yesterday. My friends, there is a lot more of this coming. How do we know? We know because there's a direct correlation between stock market and quantitative easing. I don't know how much more clear it could be. Red line is the stock market, S&P 500. Blue line is quantitative easing. Every time they pile money into the market, and for whatever reason, I was having a hard time with the Fed website. Can't get this to go back. So I think they stopped. I might have to use a different index. They stopped doing this part of the history. I'm not sure what changed. But the stock market came up from 666, right? It's down to 666 at the bottom. They're flooding the market with money. President Obama said, if I could buy stocks right now, I would. Stock market started going up. When does it have a hard time? Well, they stopped adding money. Stock market went sideways for 2 years. Kind of a stealth bear market here, right? Here to here, same 2 years later, same price. Then they finally tapered. And we got smacked 2018. Bam, bam. And then they bailed out the repo markets. And market starts going up. Coronavirus crash, which probably was deserved either way. And they spend more money in the history of humanity in a couple of months. And then they keep on putting it in. And look at how much that hugged. So I would say, take a look at this spot, right? The market has been hugging the QE for a year. If they had gone sideways on QE, if they had just flattened it out, if they had just ended it, probably when they should have, stock market wouldn't have gone up as much. Why'd they do it? So somebody sent me a video today, DiMartino, I forget her first name, Laura DiMartino, and I've actually met her pop, and talks about how the QE has worked with the market and what the impact is. And I think what you have to consider is that the upside that we've seen in the market from QE might be rivaled by the downside that we see. I don't know that we're going to give up everything. However, a couple of years ago, I was showing you a chart, and it was a megaphone pattern. And we broke out of the megaphone pattern on the upside from the QE. Well, what's a megaphone pattern? Megaphone pattern means that the expectations of the market are broadening to both upside and downside. And we've seen the upside. I'm not going to say that the stock market gets back to the 2018 lows or below. I am going to say that it's possible. So when Jeremy Grantham and Jim Rogers and some other big time investors say, look, when Charlie Munger says, this is the worst I've ever seen it for valuations, and I can look at Stock Rover and anything else I want to look at and say, yeah, pretty bad, right? We can pull up our handy dandy valuation charts, which might be in the linked article, right? Overvalued, overbought, overleveraged, and the Fed's tightening. What could go wrong? Well, I think something that looks a lot like 2018 could happen. Spike in volatility, Q1, some repair, and then end of the year shoot up. We'll see. I made a lot of money on those volatility trades back in 2018. Look at this. Grr. Anybody who doesn't understand that that's a big deal isn't trying to understand. Well, they got our back. The Fed's got our back. They won't really let it go back down. Yes, they will. Do you know why they will? I think it's important to understand what the Fed's motivations are, so I'll talk about it again. The Fed's job is to protect the dollar. Throw out all the dual mandate bullshit. The Fed's job is to protect the dollar. That is their job. They don't tell you that's their job, but that is their job. Why? Because having a strong dollar is the free ride of the universe. We get a discount on everything. It's why our standards of living are so high in such a flawed system. Because capitalism is the worst system out there, except for all the other ones. One of the articles I'm writing over on Medium, because there's a lot of people who blame capitalism for problems, is look, capitalism's not the problem. It's greedy, lying, cheating assholes who are. So that's where you have to fix things. It's not the system. The system's awesome. It's the people inside the system who figure out, well, I can outsmart a couple other people, or I can con them, or I can get these rules changed, or I can skirt the system somehow. I can gouge here. I can manipulate there. I can evade taxes this way by creating a pretend currency out in the cryptoverse. And I just skim off of all the chasers and FOMO people. Because I'll already have my cash when it crashes, and my real estate, and my gold, and my private jet. Oh, wait, I didn't mean to put him up yet. Oh, yeah, I did. So I hope you read this article, because I told you the future of the world right here. It's not getting a lot of plays because, I don't know, the Seeking Alpha editors are weird. I just told you the future of the world. So I'm going to rewrite this article in a different way with a different title. I'm going to get rid of the macro dashes because that's not taking off. Just put a regular title up there. The future of the world is this. Read this article. Very simply. Wages are drifting up. And I'm talking about this over at Substack. I'm launching at Substack soon. And it's just going to be sustainable growth over here. What do we know? We know that the velocity of money comes down as population ages. It's pretty easy to take a look at and go, oh, I get it. Population really kind of leveled off in here. Financial crisis right there where we hit an inflection point. Weird. Population's getting older. Velocity of money, right? This is the peak of the boomers. Then coronavirus pushes velocity of money off a cliff. The trick for the Fed is to get velocity of money back up to around here, then hopefully at least jitterbugs for a while before it gradually goes back up. Which, when I say gradually, I mean like 20, 30 years from now. How can they make that happen? Well, somebody else posted a video from Raoul Pal from Real Vision. Him and I see eye to eye on a lot of stuff. I was following him before you knew who he was. Smart dude. Why was I following him? Because he was one of the big time traders on the macro desks. We were following him in the 90s, right? And then the internet made him discovered. So the Fed balance sheet has been fighting deflation for all these years, since the Great Recession. Velocity of money's been coming down because the function of demographics. And now what do we see? Velocity of money can't go below 1 because a transaction is 1. But the pass on, right, as a transaction occurs, then another transaction occurs, another transaction occurs, was much higher 20, 30 years ago. It's about as low as it can go right now. So the velocity of money dictates, requires, insists that it needs to go higher at some point for the economy to grow and, more importantly, for standards of living to increase. So that's 6, 7, 8 million people who having a hard time with the labor market and the employers on the other side. That's a big part of the solution. Because what we know is that people in the bottom half of the income stratosphere spend almost everything they make. It's good for the economy. And the trick is hopefully that they have some money for retirement someday so that the system doesn't have to pay for their retirement, which could be 30 plus years. So the Fed has pumped all this money into the system. It's out there. It's all over the place. What the Fed is about to do is create a correction in inflation. Inflation is going to come back down. It'll happen by the second half of next year. It'll probably be back to being a problem before that, right after that. Like 2023, inflation will be a memory. Maybe not till summer, but at some point, 2023, inflation will be a memory. Because unless this really starts to turn up, you can't have inflation. The supply chains are all moving already. It took Joe Biden 2 months of threatening people to fix that. The ports are starting to clear out. China, which controls 85% of the shipping containers, was like, okay, well, done playing games. Let's get this stuff fixed. It's only a 3 or 4 month process to fix that, plus an arm 1 or 2 for, moving it around on the ground. That's all it takes. From the time a ship leaves the Far East to the Western world, whether that's Europe or the United States, to it's unloaded and in your shopping cart, online shopping cart or basket at Costco, those are my two, it's about 3 months. That's why when you order something directly from a manufacturer in China, which you can do on Alibaba, if it's not manufactured already, they'll manufacture it, pack it, ship it. So unless you're going to pay for air delivery, it goes on a container, next to the ones carrying the uranium and the terrorists. And it gets here eventually because it goes across the ocean. And then it unloads and it gets on a truck, gets on a train, goes through the middle of the country, ends up wherever you are. If you're on the West Coast, you get it a week earlier. New money, Fed balance sheet. Where are we right now? What animal is this? It's an alligator, right? Alligator jaws. What do we know about alligator jaws? Oh, I'm sorry. Somebody corrected me. Danielle DiMartino. She was talking about this in a video too. This was being talked about by Raul. The alligator jaws always what? They close. Now, it's going to be a slow motion close. This is a sleepy alligator. It's not going to be like, wow, gotcha. It's going to be like, gotcha. It's going to take 20 years, maybe 30. But we're probably at the point where the Fed is going to start managing this in a way to get it to drift up. And that means the next time it's going to be different. They've already teed it up, right? They've already teed it up. They've put $1 trillion on the side, kind of a side fund, to make sure that the repo market doesn't get beat to hell. And they've changed the rules so the money doesn't end up in the stock market, at least mostly. So all those kids on Reddit that have been following the repo market, not having any idea what they're looking at, should go on Reddit, figure it out. The Fed is basically saying, look, we're going to be there to make sure the financial system doesn't collapse, but we're not really there to help you make money in the stock market. Grow up and figure it out. But you're getting an opportunity to do some things at what is probably a historic inflection point. The velocity of money is pretty much done going down. I mean, not that it can't jitterbug. It's going to start drifting up again. And that is largely tied to the millennials who are smack dab in the middle of household formation and raising their kids. The Generation Z will be there in 3, 4, 5 years. My daughter decided to start now. So all these transformational things, they're not speculative. Somebody said I was speculating. Everything in investments is speculation. So let's get the fast acquisition, which somebody said that, they were a schmuck for following me into. We bought fast acquisition at about $12 a share because it just kept hanging out there. Fast acquisition is supposed to merge with Fertitta Entertainment, which is Golden Nugget, all his restaurants, a bunch of stuff in Houston, and was Golden Nugget online now is 10% of DraftKings. Comparatively, similar to Caesars and MGM, but just a little smaller. And we've taken a look at the charts of Caesars and MGM. Caesars in particular has gone up, 1,000% since the bottom? So the downside on this is $10 a share. Why? Because there's $10 a share in cash. You're really only risking about $2 with an upside of 5 to 10x. So, okay, let's see here. I always hear that I should have 3 times more upside than my downside. On this one, my downside was 20% and my upside was, say, 500%. But hey, that qualifies. Understand, there's $10 in cash inside this vehicle. If the deal doesn't happen, they're just going to distribute the $10 in cash. That's why even with this news, the Fertitta might be trying to back out. And I think that if you read the article, I think there's a good chance he's just trying to get more of the deal, because 10% of this is almost $1 billion. That's what I think he's trying to get. I mean, mathematically, that's what makes sense. He just might not be able to let go of the keys to the car, though, right? He might not be able to take his hands off the steering wheel. It could be it. You're all do-it-yourself investors. Somebody mentioned that, hey, maybe we should just all hire you to manage our money. That's probably not a horrible idea, but A, I get tired of asking. B, I get tired of talking to you on a one-to-one basis. It's not that I don't enjoy the conversations. It's that it just takes a ton of time, right? It's not scalable. That's why it costs 1% to have your money managed, or 1.5%. It's because it really takes a lot of resources and time, or extra employees, to handle each relationship. Which is why I brought my firm down from 160 families down to 40. And I'm going to get it back up to about 100 over the next couple of years, but that's it. Then I launch an ETF or two, which is kind of what I've been thinking lately anyway. In any case, fast acquisition. Upside 500% plus. Downside 20%. That was the beauty of all of these SPACs. Is if you didn't like the deal, you could take the $10 in cash, or if the deal never happened. Now, you have some other ones that, were diluted, and I told everybody that, look, I'll have 20-30% downside on the dilution in the short term. And I think that most of these SPACs, the ones that we've picked anyway, they all have 500 to 1,000% upside. I wouldn't bother with them if they didn't. The only one, the one on the low end is probably WeWork. I told you I think that might just get to the 30s or 40s or so. And then they'll start paying a dividend, but they won't be growing much anymore. But we'll see. I thought it was worth the risk because the nature of the workforce is changing so much, so fast, and so unpredictably, and they're in a space that might benefit hugely from that. And all those satellite as a service stocks, it's the future. Space is the next trillion-dollar industry. And in fact, it's a multi-trillion-dollar industry that's coming, and we'll probably see 4, 5, 6 companies in the satellite as a service space that end up being on the S&P 500. $100 million plus companies probably. So I bought the 4 stock basket. I've whittled it down to 1, but I'm going to buy the other one. I'm going to buy that one back as soon as they get their dilution dip out of the way. Understand what's underlying all these different picks. The SPACs, if you take a look at the history of the SPACs, is not any different than the stock market. You got your stinkers, right? You got your stinkers, but you also have a whole bunch that went up. All kinds in the last year that are way up. What does this prove? It just proves these are just companies. Just got to evaluate them as companies. That's it. Evaluate them as companies. And that's what I'm doing. In 2 or 3 years or 4 years, the ones that I've picked out, I don't know which ones, but you're going to have some big winners, right? Like this is a meme stock as far as I'm concerned. This one I don't know anything about. This one I don't. Well, yeah, I know what this is too, right? Planet is owned by these guys. Planet's going live in the next day or two. Probably going to jump. Probably the first one. The next one that jumps. MP did well for us. All right. So a couple signals in the market you should be paying attention to. So Mr. Musk sold $10 billion worth of his shares. $10 billion. Do you think he can afford a house now? Why do I point that out? So you've got all kinds of CEOs and big time people selling shares. That means 2 things. 1, they think their shares are pretty expensive, but 2, they think there's some pretty neat things coming that have to do with this. There's more money to be made out there, folks. And it's not in the old grandma and grandpa stocks. The grandma and grandpa stocks, this is their future. It's already it's their present. Stocks that you think are safe are not safe. All these people chasing dividend yields for companies that have debt and no growth, the Fed is telling you, hey, let the zombie wars begin. I didn't mean to have bust a picture up for that one, though. That's okay. It's fitting. Nobody knows what he is. I still think he's an alien. So the zombie wars are beginning right now. And you have to be on the right side. Because if you insist that I'm going to turn that zombie back to life, you're going to lose. The zombie stocks have a finite window here, unless they somehow get bailed out again in 5 years, 4 or 5 years. So that's really when the Fed support is completely gone from all those bonds that they soaked up through the ETFs. And by the way, the Fed getting into a deal with the Treasury to buy ETFs, technically illegal, but they wrote a loophole. Could it happen again? Well, clearly I expect something. They've created time to allow the market to sort things out, though. That's what they've done. They've created a window the next 4 or 5 years for the stock market to sort out the future from the past. And that means that the S&P 500 maybe only goes up another 1,000 points in the next 4 or 5 years, or 1,500 points. But certain stocks will go up 1,000%, and certain stocks will go down 50, 60, 70, 80, 90. So you have to be on the right side of that great divergence, great bifurcation. I think great divergence is probably the better title. Other thing you're seeing is you're seeing regulatory pushback for the first time in a very long time to prevent the big guys from creating more oligopolies and monopolies. The Justice Department has actually been very aggressive this year about not allowing the big guys to get bigger. That's good for you. And who else is it good for? If they're not allowing the big guys to crush everybody in the market, who's that good for? I'm not going to give you this one. What stocks? That's right, the small cap. The small caps have been getting decimated here for about a month. I mean, the small cap correction is off the charts. It's only a couple of stocks at the top of each index that hold up the index. So today, on this weird jobs number that I tried to explain earlier, the market's down about 2%. I don't know if that's wherever it is now. This is an older headline probably. There's going to be a zero in there eventually. This is going to end up being a bear market. I don't know if it ends up being a 3-handle bear market or a 2-handle bear market or a 4-handle bear market. Probably a 2-handle bear market. But that still means that the biggest stocks are going to drop 20-something%, and a lot of the smaller market cap stocks are going to drop 40, 50, 60, 70, 80, 90. We've already seen a couple of them drop that I started buying after they had dropped 70% and they dropped 90%. They'll all probably get back to their highs, just a matter of how long and do they break out above that. So still, 5 and 10 baggers out there. So you pull up your handy dandy screener on TradingView, which I hope you bought on Black Friday because it was dirt cheap. And you see some stocks already grossly oversold. We took a look at Docusign already, just fell off a cliff. There's more cliffs coming, more cliffs already happening. Alibaba. I may have noticed all the articles on Alibaba on Seeking Alpha and other places. And everybody wants to talk about delisting. But what they miss is that the Alipay deal was a big deal, and that's gone. Something that I said years ago is that the structure of these VIs, that's what they are, has to do with ownership structure. Basically, Chinese people are supposed to actually own the company, and foreigners essentially get a promise. The risk with Alibaba and all the other Chinese stocks are multiple. First off, Communist Party risk, them screwing with the companies. Second, you don't really own anything. You don't have typical shareholder rights. It's kind of a big deal. Third, the United States just passed a law that they've been talking about for over a year, finally finalized it a couple days ago or a day ago, that says, hey, if you don't comply with our accounting practices, we're going to kick you off the stock exchange in 3 years. I don't know which Chinese companies are going to actually be able to open up their books and show same numbers that they've been stating. I don't know what accounting is going to be good and true versus what's going to be BS. And I would expect that most of the companies don't open up their books. They'll use politics as a pretense, and they'll get kicked off the U.S. market. Jack Ma, I think, would love to just be an American company, or Alibaba to be an American company. He's pretty much been told, go live on a golf course and shut up. We'll get you out. You can go out and do an event here and there, talk to kids about becoming smart and love China. But that's all you're allowed to say. The idea that Alibaba can't go back down to its IPO price or below is nonsensical to me. Of course it can. I don't know that I even track Alibaba. I still track Alibaba. It's the only Chinese stock that I track. And that's supposed to be pink. I don't know if it looks pink to you. You know why. Bottom fishing price I have right now at 92. I don't know if it should be lower quite yet. But this weekend, now that I have the lists broken into a growth side and a dividend side to make it easier for folks to focus on what they want to, I'm going to go through every single company, probably get rid of a dozen and add a dozen, update the chart and the bottom fishing. Every single one this weekend. That's what I'm doing. So that'll actually be your stocks of the week. I'll pick out a few to highlight. And what I'll tell you is that a lot of these bottom fishing numbers are going lower. I just can't see more of this not happening. So this is an old chart, 100-ish. I said Docusign can get to 100-ish. There you go. We're closing in. There's going to be a lot of it. A lot of these charts are doing the same things, or they're about to. And that's just bigger companies and stuff I can't cover. If you go to the entire, look at all these stocks starting to get beat up. And this is a 4-hour chart. It's just starting. Flip this over to a day, right? Fewer and fewer. Almost nothing on the monthly. And you get through it pretty quick. Remember, this is 6,500 companies, right? We took only a couple seconds to scroll to the 30s. So on the longer term charts, there's almost nothing that's oversold. You got to shrink it down to daily and 4-hour charts right now to get a lot of oversold stocks. Eventually, there will be a lot of stocks oversold on the longer term charts. And that's when, we bust out bar chart and you go, okay, who have been the relative best performers over 2 and 5 year periods? Hey, look, I know these guys. In fact, let's look at Amidas. Well, I'll just give you one stock as an example. Pretty clear, right? Might even get down to here. 9-ish, 8-ish. Bet Shooter has an idea. So a lot of these stocks where we know the company's in a great position, we're going to get an opportunity to buy them again even cheaper. So this is what I'm going to update is all these charts. My guess is this comes down to about there. That's my guess. I have to take a look at it a little closer. But right in there. And we get this back down in here, because we first talked about it here, right? You get another chance. You saw that they just did a deal with American Airlines now for fuel. Right? So somebody asks, is begin bottom fishing the price level to begin establishing a position? No, there's no such price. Begin bottom fishing is where you need to start looking and measuring your technical indicators. You want to buy things that are overbought on the RSI on a weekly chart. So down in here, 30 or below. I mean, sometimes it doesn't quite get to 30. So maybe some stocks will be in the 30s. You always, always, always need oversold indicators. Always. If you don't have, and that's in a downtrend. And it's better to buy later than sooner. I have proven that with my own account because it can always go down more. And if you buy it here, it goes down to here, you feel like a schmuck. If you buy it here and it goes to here, if it goes to here and then you buy it here, you feel pretty smart. Bought it in the same spot, but you let the pivot occur. I've made a lot of money getting really close to the pivot points, but I know that people kind of hate it. They hate when you buy something at 12 and it goes to 6, even if it was at 50 before, and it's probably going to go back to 50. You've called a lot of names. So I'm trying to wait a little longer to buy. And if it happens to be at the start of the uptrend, so be it. But the reason I always tried to buy a little early is because the first move up is usually really fast and pretty large. So I didn't usually want to miss that. But because of the nature of the Fed today and the hyperactivity in the markets and the hyper moves, right, Docusign? Did anybody think it would drop $100 in a day? Waiting a little longer probably makes some sense. And if Daniel DiMartino is right, in basically just saying what I said a couple of weeks ago, that the first quarter could be really rough, especially the second half of the first quarter, it's okay to wait. And your option trades, your option selling trades, which I talked about this week, should try to game that a little bit. So, all right, call it a day. I'm going to get my eyes checked again because we're having a hard time fixing my astigmatism, which I'm not sure is really there. And my eyes are stinging from these glasses, so we'll get to that. Ask any questions you want in the chats or in the comment sections after the articles, both websites. You can comment after the articles. All right, have a great weekend, and I think the Packers are off, so your football team's allowed to win. Take care.